welcome. You're watching SBI Mutual Fund presents Invest Smart Mutual Fund के साथ partnered by ET Now. I'm Kavita Thapliyal and today we're going to talk about a very important topic that confuses a lot of investors. A long-going debate. What are active funds and what are passive funds? And for this, on the panel, I have Ruchit Mehta, Head of Research, SBI Mutual Fund, Ravi Sharma, Fund Manager, Equity, Passive and Head of Equity Dealing, Harshvardhan Roongta, CEO, Roongta Securities. Hello and welcome to the show. And let's start with a very basic question, Ruchita. What exactly are active funds and what are passive funds?
Okay, so let's answer in the reverse order, right? So, a passive fund is one where the objective of the fund is to really deliver performance which is exactly in line with what the index is.
Okay.
So, when you look at a passive fund, the investments into the various securities or the stocks is exactly as it per in an index. So let's say you take the Nifty 50 as an example. If the Nifty 50 is comprised of 50 stocks in a particular percentage, an index fund will have the exact same securities in the exact same percentages.
Sure.
What it essentially, the core objective of a passive fund is to give you the return of the index right, at a lower cost. An active fund is actually the opposite side of it. The idea of an active fund is to beat the index, so beat the benchmark. Right. And the fund manager will do that essentially by taking what is called as an active call, which means they're taking a view on a particular stock and saying that, look, I like this stock or this company more than the other company, and therefore I'm going to buy more than the benchmark weight for this company and buy less than the benchmark rate of the other company or not buy it at all. But therefore he's taking a call that one company will do better than the other. Right. In a passive fund, you're just saying that, look, I will give you exactly the same return as the index does. So that's the key difference between an active and a passive fund.
So you're saying that passive is less risky?
I wouldn't call it less risky. What the passive fund is designed to do is to give you the return of the index. Okay. Without taking a call on any company doing better or worse.
Okay.
If that means less risky, then yes, it is less risky than an active fund.
All right. We'll come to the aspect where we'll try and understand that what kind of investor should be going for a passive strategy. But then, Ravi, let's talk about an international trend in passive funds, because there it's big internationally. Okay, in India, now that it's not catching up, but then the awareness is still at a very nascent stage, and which is why we are doing this particular show as well. But then, help me understand that what is so big about a passive strategy and passive funds internationally, and how are we catching up with that?
So, as you said earlier, this debate between active versus passive is almost like kind of going on from a decade or more. Yeah. And as we stand today, internationally, passives, I mean, it may not be right to say it is better, but definitely passives have won in terms of the flow. Okay. I mean, if we just see the numbers internationally, more and more incremental funds, whatever are coming into mutual funds, are being directed towards passive. In fact, we've been seeing outflows from the actively managed funds.
Exactly. Yeah.
So now the biggest question is why? Why this is happening, right? Yeah. The most important reason is the return differential between an active and a passive fund.
Okay.
Now, as Ruchit said, passive funds are designed to deliver or give returns that closely represent the index. Active fund, as the word stands active, the fund manager will try and take active calls, right? While doing that, the fund manager is taking a risk in terms of stock selection, in terms of the sector selection, being overweight, underweight. Historically, what has happened, what evidence suggests, for more and more number of funds, the large cap funds especially, in the entire universe of mutual funds, what they have seen is at least 65-70% of the funds have underperformed the indices. Right. This is what I'm talking about, the international fund.
Right.
Coming to India, recently S&P indices, they came out with a report. For calendar year 2022, for Indian universe, I mean, can you guess a number? I mean, what would it have been? 88% of the large cap funds that have benchmarked to BSE 100 have underperformed. Oh, that's a big number, right? Yeah. And if you go down the line, 3 years, 5 years, that number goes to 90% plus, which is a huge number. So for an investor, I mean, end of the day, the objective is to invest into markets, to get market returns, but to beat the benchmark as well, right? But incrementally, if you keep on seeing that I'm not even able to get the benchmark returns, the next question comes, why to go for active? Right. So that's the reason why driving internationally, more and more flows are driving towards the passive, and same will be the case with India as well.
But then, Harsh, one thing that we can also look at, and in continuation with what just Ravi answered, internationally markets are much more mature when it comes as compared to India. Obviously, over here, our fund managers, especially active fund managers, have this opportunity to strategize. Their expertise, the alpha that we talk about. There is still a lot of scope. Apart from that, or even despite that, we are seeing that there is rising interest in passive funds. How is our market differently placed when it comes to active and passive strategy as compared to what we just explained internationally?
If you're talking about large caps, the SEBI definition of large cap is top 100 companies. So the universe to invest for a fund manager is essentially out of those 100 companies.
Totally. Yeah.
So it's going to reflect, and it's going to be basically be a market, index hugging portfolio kind of a thing, even in an active portfolio. So what is the scope that that a fund manager has to generate that additional alpha? When you look at mid cap segments, then in that case, so mid cap, the definition is 150 stocks. Okay, and then again there is some scope for a fund manager to generate alpha. You go to the small cap, so all companies beyond 250 are defined as small caps. So the universe is really large.
Right.
So your question is, so how are we going to go ahead looking from here, and how are our markets different? So well, the essence is going to be the information dissemination. So in the mature markets, when you say the internationally the markets are mature, I mean the information dissemination is through and through. I mean it's virtually everybody gets it at the same time. Okay, so how does one fund manager take advantage of that information over the other when it's coming to everybody at one time? In India, still there is some gap over there.
Right.
Okay, so there is, that if you can get that bit of development that is happening somewhere in advance, or you can anticipate it, then probably you'll take advantage of that information or that development that is happening. So, well, yes, we are heading towards a developed and a matured market, but there is still some area left where a fund manager probably could take advantage. However, having said that, that is more relevant to which segment are you talking about?
Right.
So as I said, large cap,
Exactly.
the potential is very narrow, very less. In mid cap, it's little more, and small cap is even larger. So for an investor, how should you look at it?
Yeah.
If I am looking to allocate towards large cap, probably I'll look at index, the passive funds. If I'm looking at mid cap and small cap, probably I would like to look at the active strategy.
And this can be constant for a individual's portfolio. This can also change as per market cycles.
Yeah, definitely. It's up to the individual, his investment horizon, his strategy.
Yeah.
Like passives, you can, like what he said, you have a core portfolio, which can be like constructed using a passive fund. Across that core portfolio, you use satellites, which are your actively managed funds, maybe a mid, a small, or maybe a multi-cap fund, which will help you generate that extra alpha. And whereas your large cap portfolio keeps on giving you the market return at a lower cost.
You really can't have a passive strategy in mid cap and small cap, right?
Well, a lot of fund houses have done that. They've launched passive strategies on the mid and small cap side as well.
Okay.
But I think, as Harsh has mentioned also, right, on the mid and the small cap side is that the information research capabilities are much higher on the mid and small cap side, because it's just a large number of companies.
Exactly.
Right? When you look at the large cap companies, and it's interesting if you look at some of the data providers, Infosys or Reliance, the top large cap companies, well-known famous companies in India, you would have almost 40-50 analysts tracking that one single company. Now, when 50 people are closely monitoring a company, right, the ability of any one single individual to have a better analysis, it drops dramatically. But when you come to the mid and small cap segment, right, you probably have 5 or 6 people looking at a company closely. In many cases, we have found that people have just not looked at a company because either it's too small, either it's too niche, or it just didn't pop up in anybody's radar. So therefore, there is that opportunity to create significant alpha by putting in a lot of research efforts beyond the mid and small cap space. So yes, there are index funds in the small cap and mid cap segment, but I would reckon that you will generate over a longer period of time better alpha by being in the mid and small cap space.
Right. So would you recommend passive strategy for someone who is just beginning the investment journey? Is that the right approach? And also, what is more cost effective? Active strategy or passive strategy?
Okay, so your first question, what would we recommend to a newcomer?
Yeah.
Okay, somebody who's getting into the equity markets for the first time.
For the first time.
So what are the thoughts in that individual's mind? So first is equity markets I don't understand.
Right.
Okay. Secondly, what will be the kind of returns that I will generate from equity as a market? I mean, equity as an investment. The third question says that if I'm betting my money, on a particular fund manager, what is the likelihood of him or her outperforming the market? So there are three variables, there are three moving parts, and I don't have answers to any. Now, in this case, it's a safer option for you to say, what will my equity do? Whatever, if I'm investing into a passive fund which is tracking the Nifty 50, for me, it's simple to look at saying that, what has Nifty 50 done over the X period of time? 3 years, rolling return, 5 years, 10 years, 15 years. So that gives me a sense that markets have performed in this line. So one question is, taken off the radars when I take a passive fund strategy. The other one comes into saying that, how will equity perform? Okay, that I said that it kind of answers. It gives me visibility to say that, okay, this is what I'm expecting, and what will happen to the index will happen to me. So I'm not going to be the one. I'm going to be singled out. The third question that arises: if I give my money to an active fund manager, what are the chances of him or her beating the index? So there is where the data that Ravi spoke about comes into picture, saying that the past data of FY22 has said that 88% of fund managers in the large cap space particularly haven't beaten the benchmark. So I said, is my fund manager going to be in that 12%? I don't know. So if I want to take that bet, I will. Yeah. And if I don't want to, I'd simply go for index. Now for a new investor, I'm sure most certainly would not want to go into that 12% category and would say that I'd rather stick to something which is more visible and consistent. I said progress as an investor. Like I'll be probably in a passive strategy initially, and couple of years through, I will possibly start understanding what markets are doing, what my fund, is there an active fund manager who can do better, and then maybe I migrate. Now if I'm the same investor coming into the mid cap, so when I invest, I'm not going to invest everything only in large cap, right? Now I will allocate something to mid cap. There again, what Ravi mentioned comes very, very effective, saying that you have a core portfolio and a satellite. So large caps becomes the core, and the satellite is where you're trying to generate alpha, and mid and small cap is that area where we believe, all of us together believe that there is some scope to generate alpha on an active strategy. So what I do is allocate in the mid and small cap segments, I allocate towards an active strategy. So combination of both will be better. It's not either or. Okay, so that I think will be the right combination that any investor should look at.
But even within passive strategies, Ravi, what exactly should be one going with? ETF or index or any other category? What's the universe like?
That's a good question. So people when we talk about passives, what comes to mind is just ETFs.
Right.
So actually passives is index funds plus ETFs. Index funds are quite simple. Just replicates the index, and it's like any other open-ended fund where you can just subscribe to the AMC, you give the money, you get the NAV statement and everything. ETFs are essentially exchange traded funds, so to say exchange traded index funds. Now this same index fund is available to you as an investor to be bought and sold on the exchange as well. The best part is you can trade in this mutual fund unit on a real-time basis. That is the biggest differentiator between an index and an ETF. Both the type of funds are doing the same thing. They are replicating the index. But for people who want to try to even time out during a day, what's the best time to buy into a market? Because ETFs are listed on the exchange. The NAV keeps on tracking the real-time prices of the underlying stocks. And there are market makers on the exchange who are appointed by the asset management companies to provide liquidity to create market on the exchange. So these guys will keep on offering bids and offers on the exchange for people to go and trade on the exchange. So the biggest advantage between an ETF and an index fund is the real-time pricing. Another big differentiator between an index and an ETF is when you are an investor into an index fund, any subscription or outflows that happen into the fund, the cost associated for subscribing to or purchasing or redeeming those securities is borne by the entire set of existing investors. For an ETF, whenever new money comes in or existing money goes out, all the incidental costs are being borne by that particular investor. It is a very big difference because indirectly in an index fund, you happen to share the expenses of the other investors as well, which is not the case with ETF. So these are like two big differences between an ETF and index. And obviously for an ETF, you need a demat account, but for a normal index fund, you don't need a demat account to subscribe.
But then you also mentioned something about tracking. So what exactly is this tracking error that we hear a lot about?
So a tracking error, put simply, is that if a index fund is investing in, let's say the example of the Nifty, right? So if you have to buy 50 stocks of the Nifty in a particular weightage, so let's say one security is at 5% in the Nifty, right? Did the fund by exactly 5%, or was it a little difference? Now, at times, because of the movement of stock prices, because of cash flow movements, because of certain expenses, you are never always exactly at 5%. You are a slightly little less than 5%, sometimes slightly higher than 5%. So this slight difference between the index fund and the index is called as a tracking error.
Okay.
A good index fund will try and lower that tracking error to the minimal level possible that's there. That's where the skill of a index fund manager is, that how close are you to mimicking the index's performance given all the various constraints of cash flows, the need to buy and sell securities based on how the money is flowing, transaction cost, market timing, etc.
So Harsh, what kind of ETFs can be bought and what kind of indexes should be going for?
Oh, well, I think for a layman investor, I think that's the person you're talking about.
Yeah,
right?
yeah, totally.
I mean, for a layman investor, you know, look at indexes that you can track yourself. Okay, so if I talk about a Nifty 50 or a Sensex 30, I mean, these numbers are going to be flashed on your mobile screen, as a push notification by some or the other mobile app. So these are the indexes that you can track. How simple it can be, like, if you've invested in a Sensex 30, for example, or Nifty 50, and markets have gone up by, say, a percentage point today, your funds have done 1%. It's as simple as that. So invest into those indexes, the indexes that you can track and understand, because that's eventually the purpose, right? There could be indexes which are others also. The indexes are created across a lot of things, but you may just want to invest in one index which you can track and that represents the entire market. A diversified index fund, right? And that is the Nifty 50 or Sensex 30.
Right.
So that is simple to begin with, and then probably you can migrate higher. As I said, you can progress yourself. As you understand markets, you can progress into more specific indexes in case you wish to. But index, essentially, for a layman investor, is more to do with the generic market and the BSEs and the NSEs indexes, indices. That is what we're trying to do.
So now two questions to you. Market makers, index funds or ETFs, and also internationally, what should be the strategy going in a passive way?
So market makers, your first question, they are essentially appointed for the ETFs only. So index funds investors can come directly. So there is no need of a market maker out there. It is essentially only for the ETFs to provide liquidity. International funds, you can have exposure through ETFs. I mean, a lot of options are available through a normal channel also. So as a diversification, I mean, if you want in your portfolio, you can definitely have exposure to the international ETFs as well. It's any other kind of vehicle.
Exactly.
Whether you go for an actively managed fund or a ETF for the international exposure.
So now the question rises, if you have a lower expense ratio, the return also will be low. On higher expense ratio and higher return, how do you balance this out, this active and passive strategy?
I think it kind of boils down to, as we've been discussing, right, that where is the investor in their life cycle of investing and what is their education with regards to investing per se. If you're a first time investor, you don't understand what markets are, but generally you know what the Sensex or the Nifty is, right? So because it's there on television, newspapers, people know what, they understand it. Then you should actually look at passives as part of your investment strategy. I mean, we always tell investors, if you're a first time investor in equities or into mutual funds itself, then you should probably start yourself with from debt products to conservative hybrids, and then scale the ladder to pure equity fund. So passives play a good, interesting role over here. The second stage in where passives can actually play a role is that when you are at the fag end of your career, when you're looking to take a retirement, you may not want to take the extra risk that an active fund may want, right? Because you are really looking at decent return but low volatility. Right, you want to beat inflation, you want better than fixed deposit returns, but you don't want the risk that pure mid and small caps can actually have, right? Therefore, passives there also play a very crucial role. So it's about the stage of life the investor is in and the education that the investor has about markets and investing, and depending on that and basis, advisors like Harsh will tell you, you should look at the passive as a core part of the portfolio at different stages of your investing journey.
So over here, what also we've seen is that a lot of risk averse investors have just a passive strategy, and sometimes we see people going all out and in fact raising up their risk profile and having active and heavily invested in small cap kind of strategies also. Two extreme cases, what should be done?
So in fact, I'd like to just make one correction here. If you're investing in passive, doesn't mean you have a low risk profile. Okay, that's the first thing, because take an example. If investing into an index, okay, that's a passive strategy. There is a market volatility risk on that. So it's not that. The only thing that is taken away in a passive fund is the fund manager.
Fund managers, yeah.
Okay, so what you're trying to only do is saying that I don't want to depend on the active decisions or the calls that the fund manager or that research team is doing. Okay, but equity risk is still there. In many cases, Kavita, in many cases you will notice that probably when the markets fall, okay, the index will fall in line with the market. I mean, that's the purpose, right? There is a case where a active fund manager may probably fall lesser because of being in cash calls. I mean, putting up, they may just feel that I don't like the valuations, so I stay more in cash and I invest less into the market. So when the markets fall, the index will fall in line with the market. But an active fund manager will probably be able to limit the downside.
Right.
So it's not about saying that if you're investing in index funds, you're a passive, you have a low risk profile. No, it doesn't mean that.
Okay.
It just means that you don't want a human bias to your investing decisions. So that is all that it means. Now, what investors unfortunately do is, they think investing in small caps is that because they have a huge risk appetite.
Yeah.
That's a wrong notion. I mean, you have to understand there are two ways to take risk in the market. One is that if you have a lump sum, you still invest in STPs. You do STPs. So that's basically saying that I don't have the risk profile as much as an investor who invests the full amount as lump sum. So that's again a definition of risk profile, right? But the product is the same. It's how you come in the market. Okay, so what you need to understand by investing more in small cap, it's not that you're trying to say that I'm a very educated investor. It doesn't mean that. An ideal portfolio has to be diversified.
Right.
Somebody may have a higher allocation to small cap and less to large cap and vice versa, but it has to match with your own profile, in your own goals, in your timelines.
Right.
You can't be reckless, okay, in the name of taking risk.
Very important.
Yeah,
very
so you have to be very careful on that. And one more point I'd like to, feed in with that international fund that you asked about. So I have a view on that.
Okay.
If you allow me to.
Sure.
Yeah, okay. So, when I invest internationally, so my view is that I am going to give my money to a fund house in India whom I can manage and track. However, if it's a feeder fund, so basically I'm investing internationally. So my fund house is going to take the money from me and simply go and hand it over to an international fund manager. Now, I don't know how that fund manager is performing. Okay, so do I at that stage want to take an active call or a passive call? So I'm a firm believer that if I'm investing internationally, I'd rather take an index like an Nasdaq 100 or an S&P 500. So it just assures me one thing, that I don't know the fund manager internationally because I can't track, I can't monitor. But my money goes into Nasdaq 100. So whatever Nasdaq is doing, my investments are. So despite being from the market, despite being in this industry, in this field, internationally I take a passive strategy because I don't know the fund manager who's internationally managing my money in this case.
Right.
So it all depends on what you understand, where you're comfortable, what gives you peace of mind, and you sleep happy. You don't want investments to be bothering you in the midnight and getting up and
that's the overall mantra for having your investment portfolio right. So it's not the case of either or. You need to have passive as a part of your core portfolio, and then obviously active strategies diversify as per your satellite portfolio. But then this also comes in the line of your financial planning and the way you've aligned your goals. So strategize it and maybe consult a financial planner, or maybe just keep watching our show. Thank you so much for being on the show today. That'll be all. Thank you so much for watching. Goodbye.